There's something for everyone at Bursa. What does that mean?
Different people have different investment goals. They range from being calm and cautious to pulse-raising adventurous. But the one thing all investors have in common is making money. The good news is that the stock market has something for them all. We will talk about the more conservative methods of growing your investments here because they are a good way to learn the ropes.
You can become a shareholder in all kinds of companies. Many provide dependable growth and regular dividends. In fact, Bursa Malaysia's main daily index, the FBM-KLCI, is measured by averaging the daily ups and downs of the top 30 of those types of companies. These shares are called blue chips, and they are favorites with large-scale investors who need to achieve steady returns, such as retirement funds, unit trust funds, and they might just suit you.
At the other extreme, there are companies that are considered more speculative, meaning their stock prices can be more volatile. They are often less expensive to buy, and there is a temptation to dabble in them because you can afford to buy more shares.
But remember, a 10% return on 1,000 ringgit is still a 10% return whether you have 10 shares or 100 shares. So think about the returns you want rather than the number of shares you can buy.
Needless to say, if you are just starting out, we suggest you do what the successful fund managers do and stick to the companies with solid track records of regularly making money for their investors.
You can buy into industries that you like and with which you are familiar, such as airlines, telecommunications, manufacturing, banking, utilities, oil and gas, property developers, and much more.
And speaking of property, you might consider REITs. REITs are shares in companies who own and manage portfolios of real estate, such as commercial buildings and shopping malls. A REIT is a real estate investment trust. If you like owning real estate, then this is the easiest way to get into the big end of town.
Then there are the ETFs, exchange-traded funds. They are like many other types of managed funds, except that your money is not locked in for a fixed period. You can buy or sell your shares to take advantage of the rises and falls in the fund's share price. A typical ETF might track the stock market index, which may be an easier-to-follow investment that over the decades has always been seen to rise.
Bonds and sukuk, sometimes called Islamic bonds, are different from stocks. When a company issues stock, they are selling you a share in their company. When a company issues bonds, they are borrowing money from you with the bond as collateral. They borrow for a fixed period of time, which can be 5 years, 10 years or more, after which they promise to repay the loan. Meanwhile, they will pay you regular interest called a coupon on the money they borrowed from you. But while the bond or sukuk is issued for a fixed number of years, you can buy and sell at any time to take advantage of fluctuations in the bond price.
It's worth mentioning one more thing before we move on: the difference between an investor in stocks and a trader. Investors think long-term. Warren Buffett is an investor. The people who manage unit trust funds are investors.
Trader, on the other hand, is always chasing a deal, day by day, sometimes minute by minute. It can be an adrenaline-filled, exciting existence, but it's not for beginners. That's why we will keep referring to you as an investor for now.